Welcome to the Intermediate Financial Accounting class to discuss material related to income statements. We have been familiar with the income statement, which is one of the reports in the financial statements. We have even often prepared income statements. An income statement is often used for decision-making to analyze the company's performance. Stakeholders, especially investors, need information related to income or profit and its components to assess the company's level of profitability. The current session focuses more on the deep understanding of the material related to the income statement that we have known so far, including the types of components in the income statement and form of the income statement. Before discussing the income statement in more detail, we need to remember the types of financial statements according to Financial Accounting Standards in PSAK number 1 paragraph 9. We already understand that the income statement consists of: first, the financial position. Then, there is an income statement, also known as a comprehensive income statement or statement of comprehensive income. Another report is a statement of changes in equity. There is also a statement of cash flows. Then there are notes to the financial statement, and finally, there is a statement of financial position at the beginning of the nearest previous period when the entity applies an accounting policy retrospectively. Companies generally have these 5 financial statements. The last part of the financial statement is prepared when the company applies accounting policies retrospectively. We will discuss this material in more detail in another class of intermediate accounting. In the current session, we will focus on the income statement. In the discussion regarding the income statement, we will start with the income statement before discussing other material that is still related to the income statement. Specifically on the topic of income statements, we start discussing the benefits of income statements, then we will discuss the limitations of income statements. We'll also discuss earnings quality. Next, we will discuss the content or components of the income statement, which consists of the basic components of the income statement, and then we will discuss the other components. After that, we'll discuss the income statement, which focuses on the format or form of the income statement. The income statement also relates to transactions regarding changes in accounting policies or methods, and also accounting errors. However, we will discuss this material in more detail in the next class of Intermediate Financial Accounting. In the discussion regarding information related to the income statement, we will discuss the retained earnings statement. We also discuss the comprehensive income statement and the statement of changes in equity. So, if we look here, this related information relates to other financial reports apart from the income statement, which is related to the numbers in the income statement. The income statement are usually used to analyze company performance in a certain period. Companies, stakeholders, especially investors, use the income statement to assess the company's level of profitability, investment value, and the company's ability to pay its obligations. The income statement helps investors and creditors to predict future cash flow. Specifically, we can see the benefits of an income statement on this slide. Firstly, the income statement is used to evaluate the company's previous performance or in previous periods. We understand that the income statement contains information regarding income and expenses that result in profit or loss. Income statement users can compare the data with previous periods for the same company. Stakeholders can also compare profit or loss conditions with other companies. For example, if an investor wants to decide whether to invest in KFC or McDonald's, the investor will look at the income statement for the two companies. Another benefit of the income statement is that the income statement can be used to predict the company's future performance. For example, when a company reports an increase in revenue every year, for example from 2020 to 2025, it has a consistent increase in revenue every year. Then investors will be able to predict that revenue will likely also increase in 2026 and 2027 and the year after. However, stakeholders should not depend on data from the income statement to make financial predictions because there are many other factors that influence profit or loss in the next year, which might consistently increase, decrease, or remain constant. Therefore, when analyzing company performance, stakeholders, especially investors and creditors, do not only rely on the assessments in terms of profitability or just look at the income statement. Stakeholders also need to look at other aspects such as liquidity, leverage, and other factors. However, at least the income statement can be used as a tool to assess the company's future performance, especially in relation to the company's ability to generate future income, which can then also predict future cash flows. The income statement can also be used to analyze risks and uncertainties related to future cash flow conditions. For example, investors can assess company performance by looking at discontinued operations data. When a segment is discontinued, there will be a reduction in income because income and cash have been generated from that segment. Therefore, investors will see risks related to future cash flows. In this regard, information related to segments or operations that still exist can be used to predict future performance rather than segments that are discontinued. The income statement also has limitations, and these limitations relate to the accounting methods and policies used. We often use estimates and assumptions when we recognize, record, and measure transactions, so this causes limitations in the income statement, which we can see here. Firstly, the income statement does not contain information on company activities that cannot be measured in monetary units. The second limitation relates to numbers in the income statement are commonly influenced by the accounting method used. The other limitation is that numbers in income statements involve the judgment of the accountant. For more details, let's discuss them one by one. The first limitation is that the income statement does not contain all company activities. Actually, this limitation is also found in other types of financial statements, especially the financial position. We understand that only transactions that can be measured in monetary units can be reported in financial statements, even though there are many other important company activities that cannot be measured in monetary units. For example, there are companies that have friendly bank employees and good customer service, so many people are interested in becoming their customers. These friendly employees are important assets, but cannot be reported because they cannot be measured in monetary units. Another example is a company that has a strong brand image, so consumers are willing to purchase that company's products even at high prices. This strong brand is difficult to measure unless the company reports it as an intangible asset. But even it must be reported as intangible assets, it still must be measured in monetary unit. So, actually, there are unmeasurable factors that lead to an increase in income but cannot be reported. Even though it is a limitation, revenue figures can be a reliable benchmark to represent the impact of brand strength, customer service, and product quality. The next limitation is that the figures in the income statement are the result of the accounting method used. For example, an implementation of accounting for asset depreciation. We have several methods, such as the straight-line method, declining balance method, and other methods. When we choose one of these methods, it will clearly affect the amount of profit generated because the depreciation expense each year for each method will result in a different expense figure. When depreciation charges differ between methods, they inevitably result in different profits or income. The next limitation is that the amount of profit or loss is influenced by the judgment we make when we recognize, measure, and disclose transactions. In the previous slide, I gave an example of the depreciation method. When we apply the straight-line method, we have to determine the economic life of the assets. For example, we can determine the economic life of 2 years, 3 years, 4 years, and so on. Of course, determining the economic life of assets is full of estimates, which will ultimately result in different depreciation charges for the economic life of 3 years compared to 4 years. It will ultimately affect the value of profit or loss. Another example is the application of accounting for receivable in the area of allowance for doubtful accounts. When we report the value of receivables at the net realizable value, we must estimate the amount of uncollectible receivables. Determining this figure is full of judgment. We determine uncollectible receivables are 10%, 5%, or 2% of total receivables. This estimate will definitely affect the value of bad debt expenses that will be reported in the income statement and ultimately affect the value of profit or loss in the income statement. After we discussed the benefits and limitations of income statements, now we are discussing earnings quality. We understand that the benefit of an income statement is that it can be used to make investment decisions and to apply credit. Therefore, companies always try to meet market expectations and try to show good performance. Accordingly, there are efforts to manage profit figures in order to produce the desired profit targets or to reduce the risk of the resulting figures. Such efforts can lead to a decrease in earnings quality, where companies can report higher profits than they should. This causes the quality of financial reports to decline. Here we will get to know the term earnings management. When we discuss earnings management, this is not necessarily an illegal act. Companies try to show the desired profit value by using methods or policies accepted by accounting standards. Earnings management is often interpreted as determining the time when to recognize revenue, expenses, profit, or losses. Earnings management practice, in general, is to increase income in the current period by recognizing income that should be reported in the next period. The company may also want to show lower profits this year compared to next year. So, the company will not recognize income in the current year to be reported in the following year. From here, we understand that it is a fact the company has that income. The company does not make up the value of the income, but the company doesn't report it in the current period. Why do companies do that? Firstly, because the company wants to show a consistent increase in profits every year until the following year. Besides, just in case next year's income is not as good as the current condition. Another reason could be that in the following year, the company wants to carry out a business strategy that requires funding from investors so that a high income value is needed in the future. Earning management can also be carried out in connection with estimated account transactions, such as depreciation and allowance for doubtful accounts or bad debt expenses. Profits generated from earnings management clearly affect the quality of earnings, which will reduce the quality of financial reports. Even though earnings management is not an attempt to deceive where the company actually has income, but is reported in different periods, it still reduces the quality of financial reports and is detrimental to investors and creditors. We have learned the benefits and limitations of an income statement. We have also discussed earnings management material. In the next video, we will discuss the components of an income statement.